And everybody knew
Surprise.
that every year at this time we talk about how September it tends to be a weaker month for the markets. The history is pretty clear on that, so you just got to get it out there. It's the worst performing month of the year on average. If you want to look just at midterm election years, more down than up. So the history is pretty clear, but I think the context matters too. One of the bits of context is exactly why do we think September is a weak month? And usually when it is particularly weak, it's because it's an unusually tough month for downward earnings forecast revisions. In other words, over the course of July and August, you tend not to have a clear view, and analysts aren't revising their estimates as much.
Right,
and sometimes the summer slows down more than companies expect. At least
everybody's on vacation, whether it be the companies or whether it be the analysts.
So it's a little bit of a slide there. It's a little bit of illiquid markets, liquidity sometimes longer term. I mean, you can go back. Art Cashin on the floor will say, well, years ago you had to have banks help to fund the harvest, and you know the liquidity came out of the banking system. So why matters, but I think what's more relevant is in strong years, September's not as scary. So when the market's been up going into September, that's usually not when you get some kind of major downside inflection point. And one quick data item on this, when the market has been up at least 5% at Labor Day, which we're up almost 10% right now, in the last 20 years, it's continued higher by year end by a significant amount, like more than 5% more.
That's a lot to do with the chasing of funds
exactly.
trying
And so
to
you
catch
have this
benchmarks.
And last year September was not even a hiccup. And so it's in bad years, in 2002, 2008, when September just buried you, you already had a little bit of a struggling tape.
All right, let me throw this out to both of you. That's a good point that it's funds trying to catch up with the benchmark.
Right.
You've only got a few months left to make that happen. When that happens and you see a big run up in the end of the year, do either of you know, and sorry to throw this at you, what happens in January and February after that?
So, yeah, January usually is a weaker on average, but nothing is static. You can't say that things are always going to happen, but you always see that little bit of a give back in January, and then people start and reset for the year all over again, and you see the following months.
I also don't know how to make sense of the fact that the seasonal stuff has become so well known. Like if you go back 20 and 30 years, it was a few people in dusty libraries who were kind of looking at this all the time, and the people in the business, as opposed to everyone saying, well, September's here, watch out. Or sell in May, that didn't work this year again. So it's tough to sort of say that it really is a driver. It just sort of presents the backdrop, some broader tendencies.
Right, as we all get this information, the inefficiencies of the market get squeezed out.
I also like to say, you know, we haven't been trading stocks for that long in a measured way. Like, you know, like the Dow has a 120, 30-year history. That's not a statistically significant sample of
Especially when you get to
what
our age.
happens, really, when it comes to what a given month is going to bring.